Hello everyone, today is the 22nd of May 2025 and this is the Just Dario Daily. Strap on folks, Vigilantes are now in the driving seat. Back in August last year, I wrote the article, If the Fed Cuts Rates, the damages will be far greater than the benefits, to deliver the following warnings. To all those who advocate rate cuts because those will benefit the economy, I dare to ask where exactly the economy will benefit in the current situation. A rate cut will not only risk triggering a resumption of forced JPY carry trades unwind, eventually putting stocks back on the brink of crashing because of forced deleveraging, but will clearly reignite inflation in a country already dealing with a cost of living more and more unaffordable for a larger and larger portion of the population. As if what I described wasn't enough already, if the Fed cuts rates, there is the ultimate risk of triggering an inversion of the US yield curve back to upward sloping. If that happens, it will be hard for the global financial house of cards to remain standing, as it happened every single time in the past. Fast forward to today, it is now clearer and clearer for more and more investors how the Fed delivering unnecessary rate cuts in 2024, whose only purpose was to pump stocks for the benefit of the Democratic presidential campaign while hiding the whole mess the previous administration made in the economy, above and beyond what previous ones before them did, was a bad and is turning out to be an expensive mistake. Donald Trump had the opportunity to slam on the brakes and stop the US economy train from heading towards a cliff. But as I anticipated in the article, why making America great again is such a bad news for many greedy US investors, the process would have been very painful for the stock market, that through such a big tantrum that the current US administration was forced to U-turn on its, to be honest, ill-conceived plans. However, while stocks recovered all the steep losses of the month of April, bond investors did not play ball with it. At first, Treasury yields started to rise again, mostly because of hedge funds selling safe assets to move back into risky ones, as I explained in the article. Tariff wars are over for now, but nevertheless, the inflation spiral will continue. But as expected, it need not take long for traders, especially bond ones, to figure out inflation is going to come roaring back up, not only in the US, but also around the world. Why? Because the tariffs charade will resume in about 6 weeks, and many trading partners are not going to be able to convince Donald to scrap all new tariffs slapped on them. But now that it's clear the US deficit problem won't be seriously tackled, especially when the US administration is about to pass a big tax cuts bill, US debt will continue growing and require more monetization effort from global central banks to keep it sustainable. BOJ, Bank of England, and the Swiss National Bank are dealing with mounting problems in their own domestic financial system. The reason why, as I warned a while ago again, without the Fed resuming QE, the US will face a debt crisis very soon. Enough is enough for bond vigilantes, who are now more and more taking with a grain of salt whatever promise is delivered by politicians. And rising yields are now starting to undermine this last ridiculous stock market rally. Yesterday, stocks did not turn significantly lower out of nowhere, but the reason was an ugly US Treasuries auction that made it clear how bond vigilantes are starting to play hardball. At exactly 1 p.m. Eastern Time, the US Treasury Department held a $16 billion bond auction for 20-year US Treasury bonds that cleared at 5.047%, or 24 basis points higher than the previous auction roughly a month ago. This by itself wasn't the warning sign. What spooked markets was that tail of the auction, defined as the gap between the rate traders expect these bonds will be paying before the auction and the rate where these bonds will clear after the auction. A big tail signals weaker demand than was anticipated. The tail of this auction was 1.2 basis points, which might look small in appearance, while in reality it is quite large and the largest in over a year, as a sign of bond traders' reluctance to buy treasuries at the current yields. As soon as the result of this auction was out, the 20-year yield in the market jumped from 5.03% to 5.12%. The 10-year spiked above 4.6%, and the 30-year roared above 5.10%. This was too much for stock traders to ignore, and as a result, they started selling because, let me remind everyone, high rates are bad for stocks, and all traders so far kept bidding risk assets, hoping rates will come lower, as the Fed and the US administration kept promising. Suppose bond vigilantes remain in the driving seat. In that case, the ripple effects in the global financial system are going to be brutal for all those countries that for years got away with unsustainable deficit spending monetized by central banks' money printing. While everyone's eyes are currently on US yields, those countries that stand to fall into serious trouble first are Japan and the UK. In the first case, the Bank of Japan has already lost control of the long end of the Japanese government bond curve, with yields now at levels that should prompt everyone to question the solvency of its insurance and pension system, along with some maverick banks like Norinchukin. In the case of UK, yields are now trading beyond the level that years ago triggered the insurance and pension funds crisis in the UK during the brief but disastrous time of the Liz Truss government. How come we don't see a similar crisis unfolding again right now? Because the Bank of England has been bailing out its local financial system since then. On one side, they set up a bailout facility that lends liquidity outright to financial institutions in such a bad shape that they don't have decent assets left to post to the BOE as collateral. On the other side, the BOE has been injecting liquidity through its short-term repo facility. Let's not forget one that was meant to be just temporary, but that is already lending more than £60 billion to financial institutions in the UK. Who is getting bailed out by the Bank of England? I'm sorry, but the public better not know, otherwise panic can spark in the markets. And as such, the BOE publicly stated it will keep the names of these financial institutions in trouble confidential. How long will it be able to do it before people start figuring out who is in trouble and react accordingly? Who the hell knows? But by experience, I can tell you that in this type of situation, things can turn nasty all of a sudden. Thanks for listening to my podcast today, for liking and commenting on the video, for subscribing and supporting my channel, for supporting me on X, and for reading and commenting my articles on justdario.com. I wish everyone a nice day.